We're calling a contrarian buy on UnitedHealth Group, citing their diversified healthcare platform as a shock absorber in today's chaotic market. In the lab, we're tracking UnitedHealth Group, up 2.9%, with a lab score of 60 out of 100 and a verdict to buy, driven by their robust platform and significant tailwinds. Meanwhile, Visa is holding steady with a 1.6% gain, earning a lab score of 59 to 100 and a hold verdict, as we weigh the implications of Trump policy risk on their transaction volumes. Eli Lilly, down 1.1%, still merits a hold with a lab score of 58 out of 100, thanks to its promising product cycle and platform advantage in the diabetes space. In the next 10 minutes, we'll dissect the engineering realities, macro forces, and insider signals driving these verdicts and deliver the lab's final assessment, so stay locked in. Visa Incorporated's price surged 1.65% today to $309.39, a testament to its robust financial architecture. At its core, Visa's technical prowess lies in its ability to process transactions, which is analogous to a high-performance computing system's ability to handle massive data throughput. A key engineering constraint for Visa is its transaction processing speed, measured in transactions per second, TPS, which is limited by its data center infrastructure and network latency. For context, network latency refers to the time it takes for data to travel between servers, and it's a critical factor in determining the overall performance of a transaction processing system. Compared to its competitor, MasterCard, Visa's system has a higher TPS, similar to how the Blackwell B200 processor outperforms the AMD MI300X in certain workloads. The Blackwell B200, for instance, uses a 3nm node generation, which allows for more transistors on a smaller die size, resulting in faster processing speeds. Today's price move reflects investor confidence in Visa's ability to maintain its processing speed advantage. As the yield curve normalizes, Visa Incorporated faces a complex macro landscape. With the Fed rate at 3.64% and CPI at 0.6% YOY, Visa's cost structure is influenced by moderate inflation. The probability of a Fed cut by December 26, priced at 32%, could impact Visa's R&D budget and CapEx plans. Meanwhile, the Trump tariffs, although not directly affecting Visa, contribute to global trade uncertainty. The U.S.-China tech war also poses a risk, given Visa's international exposure. As consumer confidence wavers, Visa's growth may be impacted. The friction of geopolitical tensions and regulatory pressure contrasts with the acceleration of digital payments adoption. With a beta of 0.80, Visa is not immune to market volatility. As the macro environment unfolds, Visa's valuation multiple will be closely watched. The wave of monetary policy uncertainty, and geopolitical risk crashes against the shore of Visa's business, testing its resilience. The official narrative from Visa Incorporated is currently emphasizing expansion into stablecoin settlement, a move positioned as forward-looking and growth-oriented. This aligns with broader market chatter, where publications like Wedgwood Partners highlight top-performing contributors and analysts ponder how far peers like American Express can rally. But the lab is looking past the press releases. Underneath the glossy headlines, the hard signals reveal a different story. Insiders have net sold 650 shares in the past 90 days. This isn't just noise. It's a direct signal from those with the deepest understanding of the company's near-term prospects. Furthermore, the last earnings report for December 31st, 2025 showed an EPS miss of -1%, $3.17 actual versus $3.20 estimate. With R&D data not available, we can only infer from this EPS miss that the revenue growth isn't translating into the expected bottom-line efficiency, which typically signals a lack of conviction in the product pipeline or increasing operational friction. When management pivots to phrases like long-term growth or well-positioned, the lab hears subtle deflections from immediate performance pressures. What management is saying is that they are innovating for the future. What the lab hears is a strategic shift to manage expectations around current profitability and competitive threats from alternative payment rails. A 10Q risk factor section would likely flag increasing regulatory scrutiny on payment networks potential margin compression from new entrants, and the geopolitical fragmentation of digital payment ecosystems, all conveniently absent from prepared remarks. We see two strong reasons to be long Visa Incorporated, namely its dominant position in the contactless payment space and its strategic partnerships. The biggest risks are intensifying competition from local players and the potential for regulatory changes to disrupt its business model. What's the likelihood that Visa's valuation multiple will contract as the US-China trade deal impacts cross-border transactions? And how will this affect its market share? The lab believes this risk is mitigated by Visa's diversified revenue streams and its ability to adapt to changing regulatory environments. With an AI score of 59 out of 100, we're watching the $310.11 resistance level, where a breakout could signal a bullish trend reversal, and the lab gives Visa a cautious buy rating. UnitedHealth Group Incorporated's 2.85% price surge today is a testament to its robust technical architecture. As a healthcare company, its core technical constraint lies in data processing and storage, specifically in its claims processing system. The analogous hard engineering limit is storage latency, measured in milliseconds, ms, which affects how quickly patient data can be retrieved and processed. UnitedHealth Group's system, powered by IBM's Power 9 processor, boasts a storage latency of around 1 to 2 milliseconds, comparable to Anthem's system, which uses Oracle's Exadata. In contrast, Cigna's system, using Dell's EMC storage, has a latency of around 5 to 6 milliseconds. This difference in storage latency, the time it takes for data to be retrieved from storage, directly impacts the efficiency of claims processing and thus UnitedHealth Group's competitive edge. Today's price move reflects investor confidence in this technical advantage. As the Fed holds interest rates steady, citing elevated economic uncertainty, UnitedHealth Group Incorporated's R&D budget and CapEx plans face friction from a normalizing yield curve. With CPI at 0.6% YOY, UnitedHealth Group Incorporated's cost structure may see some relief, but the 32% probability of a Fed cut by December 26 looms, potentially altering valuation multiples. Meanwhile, the Trump tariffs, though not directly impacting healthcare, signal a broader trade uncertainty that could disrupt medical supply chains. On the geopolitical front, the US-China tech war has minimal direct impact on UnitedHealth Group Incorporated, but sanctions and export controls could affect their international operations. As consumer confidence wavers, UnitedHealth Group Incorporated's market faces accelerating headwinds, with labor cost dynamics and public policy shifts adding to the uncertainty. The market is a wave, and for UnitedHealth Group Incorporated, the forces of friction and acceleration are in delicate balance. The official narrative surrounding UnitedHealth Group is one of steady performance, with analysts issuing price target raises and headlines touting market outperformance. The consensus among the street's analysts remains overwhelmingly positive, with 24 buy ratings against just 2 sell recommendations. Even institutional holdings are robust, with 84.3% of the company held by 4,193 funds, and the top 5 institutions increasing their positions. But the lab filters out the noise. We look at the hard signals. Insider activity shows no significant movement in the past 90 days, which, in the absence of a strong buy signal, suggests executives aren't betting their own money on a dramatic upside. More critically, the last reported EPS, earnings per share, a measure of profitability, missed by minus 0.6%, coming in at $2.11 against an estimated $2.12. This isn't just a miss. It's a crack in the narrative of flawless execution. When management emphasizes patient opportunity equity, the lab hears a pivot away from direct revenue growth metrics towards a softer, more qualitative language. This often precedes increased regulatory scrutiny or margin compression that management wishes to deflect. A 10Q risk factors section would likely flag increasing medical loss ratios, the percentage of premiums paid out in claims, or potential antitrust risks in specific markets, elements conspicuously absent from the prepared remarks. What management is saying is that the business is stable, What the lab hears is a subtle shift to manage expectations around future profitability. We see two strong reasons to be long UnitedHealth Group Incorporated: their diversified healthcare platform and significant investments in digital health technologies. However, two major risks exist: increased competition from newer healthcare plans and potential disruptions to their supply chain due to ongoing trade tensions. What's the single most critical factor that could disrupt UNH's valuation, given their reliance on Medicare reimbursement rates? Is it the Medicare expansion bill or something more nuanced? The lab's answer is that it's the latter, specifically the nuances in policy language that could impact reimbursement rates. With an AI score of 60 out of 100, we're cautiously optimistic, watching the $313 resistance level as the key catalyst to test our conviction. NVIDIA Corporation's hardware position is a competitive strength, anchored by its 608mm superscript 2 die size on the Hopper architecture. The core technical constraint is the HBM3E bandwidth limit of 5 terabytes per second, which determines the maximum data throughput. This means for investors that NVIDIA can process vast amounts of data quickly, giving it an edge in AI applications. In comparison, AMD's MI300X has a similar bandwidth but a larger die size, making NVIDIA's design more power efficient. The Hopper architecture, using TSMC's 4nm node, also outperforms AMD's RDNA 3-based products. With a CoWoS yield of 95%, NVIDIA can produce high-quality chips at scale. Today's 3.8% price move reflects the market's confidence in NVIDIA's technical lead, as its hardware advantages continue to drive growth in the AI and gaming markets. NVIDIA Corporation faces a net headwind of 8.9% recession risk as priced by prediction markets. With the Fed rate at 3.64% and a normalizing yield curve, NVIDIA's R&D budget and capex plans may be pressured, particularly as CPI rises 0.6% YoY, affecting their cost structure. The 20% chance of a Fed cut by November 26 offers some respite, but for now, monetary policy is a friction force. Tariff uncertainty, such as the Trump tariffs, adds to this friction, potentially disrupting NVIDIA's supply chain. Geopolitically, the US-China tech war poses a direct threat, with sanctions and export controls affecting NVIDIA's revenue exposure. As the market navigates these waves, social trends like AI regulation sentiment and labor cost dynamics will also impact NVIDIA's market, making the current environment feel like a strong riptide, accelerating downward. NVIDIA Corporation's management is publicly emphasizing AI demand and shareholder returns. But let's flip the table. Insiders have net sold 1,159,372 shares in the past 90 days, a clear signal that executives are cashing out. R&D spend is up 43.2% year-over-year, outpacing revenue growth, which may indicate a desperate attempt to keep up with competition. When management talks about AI demand, what they're really papering over is the risk of declining margins due to increased R&D costs. What management is saying is that they're confident in their product pipeline. What the lab hears is that they're trying to distract from the fact that insiders are selling en masse. A 10Q risk factors section would likely flag the company's dependence on a few major customers and the potential for supply chain disruptions, which management's prepared remarks conveniently gloss over. We're long NVIDIA Corporation due to their dominant AI accelerator position with the H100 and A100 GPUs and their advanced packaging and EUV technology. However, risks include potential decline in gaming GPU sales and U.S. export controls to China. What's the real impact of these export controls on NVDA's supply chain? And how will they mitigate this risk with domestic manufacturing supported by the CHIPS Act? The lab's answer is that NVIDIA will navigate these risks through strategic partnerships and diversified manufacturing. With an AI score of 60 out of 100, we're watching the $196.51 resistance level, where a breakout could signal significant upside. UNH takes the top spot today with a strong buy. Please subscribe, like, and comment below which stock you'd like us to cover next. Remember, our analysis is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. Thanks for joining us at the lab. We'll see you in the next video.